Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, November 11th, 2022. It's 12:16 p.m. Eastern Time as I'm starting the video, and what I'm going to do is cover the equity markets. It won't be a very in-depth one because I also want to cover a few other things. I want to speak on, again, do an update on crypto, what's going on there. Quick update on commodities. Not going to look at them all, just maybe a general commodities ETF and then crude nat gas. And that'll be it. So let's start with the market. Really, we're picking up where we started off this morning on the post I got out to you. This is, to me, it has been a big level and remains about 11,785 on NQ. It's also resistance, of course, on QQQ as well. And just lots of reactions. It was big support back here, then broken, back tested, and I've covered this recently. So that's where we're at. So we've rallied up there. We're coming off the strongest single day gain since 2020. And as I mentioned yesterday, the biggest gains, without exception, either come solidly entrenched in bear markets or immediately on the heels of a bear market. So this is one of the two. Remember, our bottom rate was back there in mid-October. So we'll see, and I'm going to give you some stats there. But again, that's where we're at. So that's resistance. We had divergent high there. We could certainly pop it, and whether it's a breakout that sticks, that's why I said, at least I would give it minimum a solid daily close above there. Today's Friday. So maybe you pop it and then pop up in the morning on Monday and go down. But I just wanted to show you that any pop above there is only going to set up additional divergence if it happens soon, because you can see how these indicators are lagging down below the RSI and PPI. So another thrust up, you'd have more of a distinct peaks. That's what I usually like to see, but not always. Sometimes you get these little divergences, and quite often you get these two distinct peaks with a trough in the middle, separation like that. So either way, you have it now. And you'd have it if we popped and it was marginal. So for me, like I said, I'm sitting tight right now in the shorts. May prove to be the wrong thing. There was a lot of evidence, as I've been saying for weeks, the strongest bullish technical case that could be made. It's just the fundamentals right now are really what's not supporting a rally in the market unless things change there, and I'll get to that in a second when we cover commodities. QQQ, same thing, and I got that chart out to you this morning. We'll look at QQQ. We can look at it on any time frame. This is a daily chart. That's that big 284.38ish level right there. It goes all the way back to in May. It was nice support. It was broken. We traded through there a little bit, but had a lot of reaction, especially since. Always give a higher weighting to the most recent reactions. So you can see there it is. And if you're trading off the daily time frame, then that's where you're at. PPO is still in bearish territory, meaning below these down. That's very bottom down here, below the yellow and red lines that delineate bull and bear trends. But that all can change and will change if we pop up much more. And then that's, like I said, the simple fact we went up yesterday increased the odds that we go and run to the downtrend lines or the 200-day moving averages. I would use that probably that trend line off this peak high there that comes in. And that would be, again, a potential target if we do rally all the way up there. Probably nothing more than 317. But I'm going to go over some of the market leading stocks right now and show you that quite a few are at resistance. Before I get to that, let me show you one other thing here. Let's talk about what I showed you yesterday. Where is it? Right here. Okay, so as I said, went over the 20 largest gains that have occurred in the NASDAQ ever. And those were what I gave you yesterday. This is that same chart. And what I wanted to point out to you here is one thing. Let me change my tool to an arrow tool up here. Okay. So what I wanted to show you is we're going back, and so the last bear market by that metric, if you call COVID a bear market, it was just a very fast one. Indexes dropped much more than 20%. And that was right here. So we have number 5, I have it at. This was on March 13th of 2020, right there. And that was a Friday, keep in mind. Friday the 13th. We had a rally, a very impressive 9.35% rally in the NASDAQ. So it blew away the rally we had yesterday. Considerably larger rally. And if you take a look up here, remember that was a Friday, the 13th, so this was the next trading day, the Monday, the 16th of March in 2020, and that was followed by a complete smackdown. Again, bear market rallies. My takeaway is you only see these gains, these 6, 5, 6, 7+% up days in a bear market, and very often, unless that bear market is over, that's the only exceptions. I told you the 4 there came immediately after a bear market ended. No exceptions other than that. So you're either in a bear market or you were just right off a bear market in the beginning of a new bull. That's when those happen. And of course, you want to make that case, maybe that happened. But remember, we're farther off the lows now than we were back then. So it's kind of that evidence, if you're going to use it, points more to this being a bear market rally. Not only that, and again, these are, I'm just going back, I just looked back to two most recent bear markets. Okay, so the last real bear, or at least the bear that played out for more than just a few weeks, like COVID, was back in 2007 to 2009. So in 2008, we were smack in the middle of it. So I'm going to point at that right there. This is October 13th, 2008. We had a whopping 11.81% rally, one-day gain in the NASDAQ, right? And then if you go down here and look, this was just 2 trading days later. On October 15th, you were followed by an 8.5% drop. Again, by the way, there was plenty more downside in the market after that. So, again, these are statistics, and I always caution you, you can't put too much into those, but it does help kind of paint a picture of where we probably are. And I'm going to show you a few other things. So some more important than that, you don't short an up day just because it's an up day. I shorted it and added shorts because we're at resistance right now. And I'm going to show you a few other top components. We're just going to go through the top components of the NASDAQ 100. So Apple, remember Apple was just right there flirting with that previous low, flirting with major support recently, and held it so far. And so you got to give Apple credit. Apple and everything else rallied, of course. And there's your support right there. You can see it best on the weekly chart. So Apple's still above support, but look, remember Apple's below the 200-day / 40-week moving averages, which tend to cap rallies in a bear market. So we're kind of pinched between support and resistance. Next up, Microsoft. Let's just look at the daily charts here. Microsoft. You can see I have a flurry of lines. If you turn off, let's do this. Let's turn off all the lines, and then you can see better. This was a support shelf back here, right? That was all the support from late April, looks like, to August. Quite a few reactions there, and then we broke it right here, and that took us to new lows. And ever since then, so if I just bring the line across, you can see that is price resistance right there. There's your 200-day moving averages way up here. That's still a potential target. There's your primary downtrend line. So that would, again, be a max bounce target. But, just be careful. Like I said, you never trust a bear market rally. They're fine to trade. Just don't fall in love with them, and don't be lured into the false thinking that a 6 or 7% up day in the NASDAQ could be nothing but bullish. It's bullish for that one day, but statistics show quite often within a matter of days, if not even a single day later, you're usually those big up days are just short squeezes, short covering rallies in a bear market, and they're answered with more selling. So that's Microsoft, most importantly at resistance there. Not super well defined, but decent resistance. Here's Alphabet, Class A shares. You can see here I have a line at about 95.71. There's a big old gap back here, and so it was the top of that, or the bottom of that gap. There were multiple reactions here back around the beginning of 2021, and then that's where the stock found support here. It even had a divergent low, positive divergence, started to rally, and then got clocked or stopped by this 105 resistance, which was bottom of a very well-defined trading range. So that's even bigger resistance. So the way I see this, my interpretation of this chart is we're at resistance now, and a pretty good resistance, 95.71 give or take. It's big old gap resistance back here with an even that next resistance, I should say, is 100 and change, about 100 and a quarter, and then much bigger resistance there, about 105. And so the way it works is any resistance level in a bear trend or a primary downtrend, which make no mistake about it, despite the gains in the last few days, it's still very clearly a downtrend. When does it stop becoming a downtrend, or at least that gets called into question? Well, when you start taking out these previous reaction highs, and they haven't done that yet. In fact, so we're just rallied back to resistance. I just wanted to point that out. So you have the NASDAQ at resistance, you have Alphabet at resistance, Amazon at big resistance. Remember, I was pointing this one out recently. This was a key support level on Amazon right here at about 101, 101.50 or so. And we took it out recently. We fell just shy. I was surprised. Usually you don't come that close to a well-defined support level, and that was at 84.83. But then again, it was maybe close enough to say it was, effectively satisfied to pull back to that level. We were only 2% above it when we reversed, and 2% on a total swing down, a drop of 54%. Well, maybe close enough, but it's moot. What I can tell you with absolute certainty is this is big resistance because it was big support, 101.45 right there. That goes back all the way into 2018 right here. Major reaction high there. Another major reaction high followed by a rejection. Tried to take it out, failed, went back down to this level. So it's ping-ponged here. It was a trading range at that point. When you finally got a breakout that stuck, it was very impulsive. And Amazon rocketed up and then never looked back and put in new all-time highs, right? And then it came down here and they bought. We bought that. And most recently it broke. So there's no guarantee that we can't recover it, but I can guarantee you this, that's a very significant technical level. That's all I'll say. And yeah, we're on the, that's the thing about it. All these stocks, all these big fangs have positive divergence that they manage. Most of them still kept it on the daily time frame, some of them on the weekly, some started to burn through PPO or RSI divergence, but still had it on the other, one of the two indicators. But that's it. So you have big resistance right there, and there's also a big old fat gap right above there. So that's Amazon for you. It's going to should be tough sledding going forward. So you have, what I'm pointing out here is when these market leaders, the more you have at resistance, the more likely you are to see sellers step in. There's Alphabet, the other share class. I already covered that. 96.50 on the GOOG. And Tesla. Tesla's really not participating. It's underperforming. It's held that key support level I pointed out the other day, and we know Musk had been selling some shares to pay for his Twitter folly, and maybe continues to. Tesla did hit major support the other day, 179.50. It's still above that support, so you can't write this off. You can't write anything off until those support levels go. And it still has the potential positive divergence. So it's one of two things. Either it's going to hold this level and rally, and then it's got next resistance, big resistance at 207.80. That would be a bounce target if you're bullish Tesla right there, minimum target. Or it breaks support and then the bottom falls out, because that would be a major breakdown. And it could be flagging here. It depends what happens Monday, really. I don't think anything big today. We'll see. A little bit of consolidation there after that powerful move down. But it's simple. It's got to take out the recent lows in that 179-ish support. Just one more to show you. NVIDIA. Remember, NVIDIA hit my second target on the weekly chart. It hit this was from back here. When we broke down the primary uptrend line, then we back tested there. We went down, hit my first target, bounced, hit it again, bounced, then took it out right here on a solid red candle. Hit T2 right here, and when we did, we had almost divergence there. We had it on the RSI, and now look, we bounced back to T1. Remember, T1 was the first target because it was support. It was support from this level, and the fact that we hit it and bounced helped to validate it. So where I had it as support back here, it was even better support once that level was hit and had a reaction, and then we had an impulsive breakdown. Now we're back testing it from below. So here's another market leader, one of the top holdings of the NASDAQ 100 and S&P 500 now at resistance with the key 200-day / 40-week moving averages, which just do a bang-up job of acting as support. During a bull market, you pull back to these 200s, pull back, but when you break them, boom, that's it. And then you're in a bear trend, and you come up to back test them, and you usually get rejected. So it appears that even if we take out 157.25, you've got a slew of resistance just overhead. The 200-day / 40-week moving averages, then the trend line off the high just above that, and then above that you have 208 to 68. So, it's not that those levels can't be taken out, and if they are, if and as they are, then the bull case gets a check mark. If and as each level is taken out. Until that happens, we're in a primary downtrend line. So this provides an objective short entry for a swing down to T3, as would a push up to the 200 days, and as would a push up to that primary trend line. Anything above that, and it starts chipping away at the bearish case. All right, so that's price resistance I showed you on QQQ and NQ and some of the top holdings, the S&P 500. You also have some resistance here about 397. That's a daily chart there. As I mentioned yesterday, you have some still unconfirmed divergence. You have prices making higher highs. You had a divergent high right here. That was the last one, followed by a correction. And you still have unconfirmed. We need to turn down, and we need to do it soon. Otherwise, we take out the previous highs right here on the indicators on the PPO and RSI. But as of now, we have the first 60-minute divergent high on the S&P 500 since we had back here. Last one before that was right there. Then we had one right there, and so forth and so on. So we'll see where we go from here. All right, and let me now show you something I haven't shown you in a little while, but I have in the past. And I'm trying to reconcile is not the right word, but just kind of fit this into my analysis and try to see what it means. This is UUP is the US dollar index, or the US dollar ETF, right? It tracks the dollar index, and that's in white. That's the white line here, right? And in purple I put up QQQ, or the stock market, just the higher beta, and it's going to move with the S&P, so either one. And there's been an on-off relationship, and typically for at least since this point, since COVID hit, you can see it's weird because back here you had a positive correlation between the two, a very tight one. In other words, QQQ, meaning the market was going up, and so was the US dollar. But since COVID, all this wonkiness right here, there's COVID, market plunged, the dollar shot up. And then the relationship flipped from a positive correlation to an inverse. So now I'm going to do this. It makes it easier for to kind of see this relationship here. I typed in UDN. So the QQQ is still here in purple, but UDN is the inverse dollar ETF, or ETN, ETF it says here, meaning, and so now you can see it, we flipped it around. So it's showing you then, remember, that's a that was a positive correlation with the dollar, which here shows as a negative correlation, meaning the two moving opposite. And now I'm going to wind the lines down and show you when COVID hit right here, and you can see it's been a very strong inverse correlation with the dollar. In other words, it's going to show as a positive correlation when I flip the dollar upside down. You can see how they've moved in sync. So this, and this is my job, is to show you analysis, supports a case that, because I made a case recently that the dollar had at least was poised for a major pullback. Whether it proves to be a lasting trend change or not, I don't think it will be. But there are periods in here, I'm showing you here, where there are some disconnects. For example, right here, UDN started to drop, and yet the market was still going up. But then it returned back here. About this point, you can see pretty much. And again, there's a few exceptions here where they go different ways. And I zoom in even tighter. So you can see right here with the white line going up, that's when the dollar started dropping. And you can see the stock market's climbing with that. So the stock market is liking a falling dollar, so to speak, whether it's liking it or it's a side effect of the stock market moving down. But again, none of it's random. I showed you for weeks and months now, US DOLR is the dollar index. And when you go to daily chart, we had the divergent high. Then we had a sell signal on the breakdown there. We hit my first target bounce, hit the second target, the trend line, took that out, and now we went right down. Look at that, we gapped right down through T3. So that says, unless the dollar can snap back above, the dollar is going to go down to my next target here. And then after that, I have another one at 12.848, and then ultimately this trend line here. and that's either going to continue to play out and be bullish for the stock market, if assuming that happens, or not. I just wanted to point it out because a falling dollar, should the dollar continue to fall, and the relationship continues, meaning an inverse relationship between the dollar and the stock market, we are probably going to go hit. In other words, more downside in the dollar to come in the coming weeks would coincide most likely with a lift up to those longer term, the bear market max bounce targets, which are the downtrend line right here on the S&P 500 and or the 200 days. They come in a little higher on the NASDAQ 100, so more upside. And I said this recently, I think the trade would be to favor, if you're going to use a hedge portfolio, be long tech, meaning QQQ and the FANGs, and then short certain sectors, including energy. I know that XLE isn't quite playing out so far as we expected, but it's still below the breakdown point. This is the energy sector. We had a breakdown recently, back tested, went down, and all we're doing is we're testing the previous highs, which, by the way, are the all-time highs right here. This was the bull market high. We hit it the other day. We're at it again. So we're at resistance, and we're below trend line, and we have the bearish PPO cross. So I still maintain this short trade. I still think there's more downside to come. You can have a stop above those highs. You could have had a stop above that candle there, but for now, give it room into next week, especially with that big move we had yesterday. Good chance they're going to fade some or all of that in the market, even if we're going up. I'll go back to QQQ for a second. So even if QQQ takes out my big 284.38 level right there, and we're going up, it probably will do so after back testing. There's spent a lot of energy, as I mentioned, to get up there. We're starting to get overbought on the near-term charts and everything else. And I absolutely probably put almost equal odds that they could just sell into this thing at any time when it starts looking good and then burn out the divergences. So we'll see. We'll see how we close today. I don't know if this market's going to give us any insight today. It has to, again, in my opinion, clearly take out a solid close back above 284.38. And as I told you, even unless it's anything more than just a marginal new close, a marginal new high is going to be a divergent high as well on the 60-minute time frame. So gives it a higher chance of failing. Okay, and all the risks that I and many others have talked about, potential risks in the market to the systemic risks, and it's almost impossible to know exactly where they're going to come from. We can look at a few things, some potential red flags, and again, to me, crypto's been the biggest bubble, since the tulip bubble in Holland or the South Seas bubble. There's been a lot of bubbles, or the housing bubble in 2008. Is the closest analogy in modern history is the dot-com bubble in 2000, and the crypto bubble has clearly had some air let out of it. If you want to use the word popped, crypto hasn't completely crashed. It's in a pretty powerful bear market, but remember, everything's relative. If you look at Bitcoin, where it came from, it still has a lot more downside to go. But most importantly, what I'm focused on here is we broke that major support. I talked about it recently. Broke down, back tested, got rejected. We're still well below that support level. We're below the downtrend line, everything else. And then FTX, as expected, they filed for Chapter 11 bankruptcy protection today. And so, like I said, it's I'm a little surprised that the market is just shrugging this off and had the big day it did yesterday. And because maybe I'm misreading this, maybe there's not the potential systemic risk. Let's just say, crypto starts to really waterfall sell-off, and we see repercussions again from FTX's failure and what it may do to, psychology of crypto or actual, paper losses between individuals and institutions. So, looking out there, one red flag, I pointed out CBOE, and I Googled them, and yeah, they've had their hand knee deep in the cookie jar with crypto in recent years. If you Google, they made quite a few acquisitions and ventures into the crypto world, and you can see they're just coming down now. They're at big support. So I'll say this, if you're bullish on this stock or the market, you step in and buy. This is their primary uptrend line off the COVID lows. So there's your bull market uptrend line. but just put in this divergent high recently, and this is waterfall selling. I pointed out the other day right here, and look, we're down another 4.25% today, right to that very, very good support, about 115.50. So you have price support right here and the uptrend line as well. If it breaks that, then especially with the strength of the market over the last few weeks, even especially the last few days, this to me is a red flag. So what's going on there? Is there a bombshell to be announced? Maybe not. Again, I showed you other companies, some insurance companies, some regional banks that are just falling down, spiraling towards zero. The regional banks usually they aren't going to take down the financial system, but a big exchange like the CBOE, again, it's not just CBOE. What would that do to the S&P 500 if it went to zero? Probably not a whole lot. But what would it do if there's other ripple effects throughout the financial services sector, exchanges and banks and trading firms and things of the like. So we'll watch this. I suspect this is related to crypto. I didn't do any digging on the news. Maybe there's its own problem, something non-related, but that probably has to do with the big drop in crypto and the failure of FTX, is my opinion, or my best guess. So we'll watch that. We'll continue to keep an eye. And then I put a comment under the post I made earlier today. At the time that we've had a nice pullback in crude and natural gas since then, a very sharp pullback. The time we were trading up over 4 times what the broad market, the stock market, the S&P 500 was up 0.6 of a. Here, let me tell you what it's up now. Let's just do that. We're up to 0.23%. This is the stock market, the S&P 500, up a 0.25 point, and yet commodities, and again, it's green across the board. Most of the commodities, including DJP, the broad-based commodity ETF, still up 5 times that right now. It was up 4 times that earlier. And so this is my whole positive or negative feedback loop thing. You can't have it both ways. Again, I always say, and I'll say it again, I repeat myself often because these are important things. One day does not make a trend. 2 days does not make a trend. But the more days you string together, the more green days, the more commodities. Let's just keep it simple. Look at the trend. The more commodities continue to move up, the more that means inflation is back. And you saw this was priced in. Look at commodities. So no wonder we had a colder than expected read on the CPI. And the markets treat it like it's over, and the Fed's going to now start cutting rates. And hey, maybe they will. If this happens, if we start moving lower and we move on down, I had this long-term potential target here at 31. That's going to give us another abatement in inflation. And if that happens, yes, the markets will most likely, as long as there's no other systemic risk and a big bombshell that comes out of the markets, it'll probably go up and hit those potential bear market targets, the 200 days and the downtrend lines and the S&P 500 and all that off the highs. Otherwise, and since yesterday's cooler than expected CPI print, commodities have all been taken off. They're resuming their next leg up. You've got palladium up again today. Took out, remember, was it resistance yesterday? Took it out. You have timber and forestry companies ripping. Lumber prices are up. We had today earlier natural gas was up, but it had a huge reversal, and it's down at this point in time. But when we look at the chart here, you can see this is all these commodities are in bull markets. They ended multi-year bear markets here, and they've been zigzagging higher. Natural gas is a very volatile commodity, but this is massive support here, about 1773, and we're still above it. So just watch it. I can't tell you where it's going right now. My read's not very strong. You see a lot of consolidation in here, but keep an eye on it along with everything else. Coffee continuing to move up. I told you yesterday that broke out. That was a nice setup. Shared with you recently. Where's KC? Where's my KC chart? KC coffee futures broke out of this trend line. Remember, we put in a divergent low recently, tapping on that 174 resistance. If we can pop that, coffee should continue to run. And that's KC coffee futures. There's JO, the coffee ETN, which also is moving up. Copper soaring right now. Gold still doing well. Remember, gold likes the falling dollar as well. And gold is solidly above that big 158 level. Now coming back up to the top of that old buy zone, which is resistance. So might be time for gold to take a little breather here soon. But longer term, it still looks good. Very much so, in my opinion. It looks excellent long term right now. JJC, that's copper. There's DJP I already covered. Crude oil is up again. Crude oil has been all over the place. You know, it went down a little bit recently. Biden was, pumping, taking it out of the SPR right in front of the midterms, trying to keep prices down, but it seems to be walking back up now, but I don't know. It's all over the place. I showed you yesterday on the 60-minute chart of CL. This is a 10-minute chart. This is a short-term chart. Most recently, you put in a little divergent high on the 10-minute chart here, just like you did on the indexes, and they played out. They had a nice pullback today. And we're coming up to support, so crude will probably bounce here on that line, my guess, this uptrend line. And that's it. I can go through all of them. Sugar. The point is, these commodities are ripping. Sugar was pointed out as a trade idea recently, and look at it, it's ripping up. So all these commodities are back into, hey, okay, well, we had a little abatement inflation. Maybe the Fed's going to pivot a little bit, be a little less hawkish, a little more dovish, and boom, it's going to be that. So just watch these, and 1 day, 2 days, the market's going to shrug it off. And you get a week, couple weeks, and you see the vast majority of energy or agricultural commodities and industrial metals. The market can't have it both ways, because the next Fed meeting's in December, and they're not going to back off if commodities have shot up between now and then. So that's it. So we'll watch it day to day, see what's going on there. And then that's it. Of course, I want to do an update on treasuries. Remember, treasuries had a massive breakout yesterday. These were just the near-term targets. If I turn all this off or zoom in a little bit for you, we'll do that. This was the breakout in treasuries here, and that looks like a little flagging action, a little bear flag, and we could pop. Remember, the bigger picture is what happened on the daily time frame with TYX, the 30-year yield, which was clearly taken out yesterday in an impulsive breakdown. So treasury yield should be falling, rates should be moving up, at least for the near term if this sticks, unless they back test. TLT is still at that resistance 97.92, needs to pop that and then run up there. And again, it's an objective long entry if it pops above the little bear flag, which is shown on the, I just showed you on the futures, or a pullback anyway, even all the way down here to backfill that gap. Anything much more than that would put us back below the trend line, and that would mean this whole thing was a false breakout. But that hasn't happened yet. So like I said, I'd be a buyer on strength or weakness up to, but not below that gap backfill 94.60 or so, which would also take us back below the trend line. That's what it looks like on the 60-minute chart of TLT above the trend line there. But again, you don't see the futures tell the true story because they're trading round the clock virtually, and you've got that flagging type action there. So that's that. All right, I'm going to wrap it up here. Keep this one relatively short, get it out to you guys, and if I see anything else today that stands out, I'll let you know. This has been Randy Finney with Right Side of the Chart. Have a great day.